Hello everyone, welcome to Think Wealth TV. Today we're talking about ultimate diversification. Now there is some common ways to diversify which get talked about a lot, and are kind of basic ways which I think are great and we're going to talk about in this video too, but there's actually quite a few unique ways that I think are important to a lot of investors that sadly don't get any attention at all or very little that we're going to talk about in this video as well to help you guys diversify. Now the easiest way to diversify and the quickest way to diversify is ETFs. So that's, especially for beginners, that's a great tool. We're going to pop on the screen 3 examples of different ETFs you can invest in for massive diversification. All right, the first example we're going to look at is the VXUS. It's a Vanguard S&P 500 Index ETF. And what that does is it invests in the 500 biggest US companies. So if you believe in the too big to fail, this might be a great ETF for some people that believe that. The sectors are right here. We'll talk about stock sectors later. Then we have the different holdings, top holdings for the VXUS. The main thing we're going to look at is, as of right now, there's 515 different companies inside of this ETF. So if you buy one share of this ETF, you'll essentially have a piece of 515 different companies. You won't have the whole shares, but you have a sliver of each one. Next one's the VTI. It's a Vanguard Total Stock Market ETF. So you invest in total stock market here. And again, you have the sectors over here. If we scroll down, we got the top 10 holdings again. But the main thing we're talking about in these examples is amount of holdings. This one has 3,533 different holdings. So buying one share of this ETF, you essentially have exposure to 3,533 different companies. And as you notice, these are all Vanguard funds. I like Vanguard because they're low expense ratio. Not sponsored by them or anything else. But this one's the Vanguard Total International Stock ETF. Now these are international stocks, no US exposure. So if you wanted some international exposure purely, this might be a good ETF for people. But the sectors again are right here. Top 10 holdings. But the main thing again what we're looking for is the number of holdings. 7,298 different companies. That is insane. So buying one share of this, you have not only exposure internationally, you have exposure to 7,298 different companies by simply buying one ETF. Usually people will buy multiple ETFs, so maybe they'll buy the VXUS or the VTI, and then also buy a little bit of this one to have some international exposure. All right, guys, we just wrapped up ETFs. It was kind of short, you might feel, but that's because we're going to talk about it more throughout this video. ETFs are kind of big when it comes to investing. They can be incorporated in a lot of different ways, especially when it comes to diversifying. So moving on, we're going to talk about stocks/equities, investing in individual companies. So when you're trying to diversify, one area that people like to do is they like to invest in different sectors. So there's 11 different stock sectors. We're going to pull that up on the screen now so you guys can see. If I try to name all the sectors, to be honest, I'm going to miss some of them. When it comes to the sectors, some people do try to invest in all the sectors, but personally I believe that you don't have to do that. If you don't feel comfortable investing in certain sectors, you don't have to, but I would at least try to invest in 6 out of the 11 sectors. There's also another way you can diversify when it comes to different market caps. So there's small market caps, medium, and large. Those are the general ones. Small meaning they're kind of smaller companies. Now they're still worth a few $1 billion, but that's considered small. Then there's medium caps, which are a little bit bigger. Then there's also large caps, which are the very big companies. And then there's newer ones they talk about, which are called micro caps. Those ones are 50 million to 300 million. Those are very small companies. So if you're new to investing, it might seem like a lot, but it's actually quite small. And now there's a new thing they call mega caps. Those are 200 billion plus companies, which there's quite a few of those. Now, if you're watching this and you're thinking about individual stocks, you might be wondering, okay, how many companies should I own? And that's a good question. You know, how many is too much? How many is not enough? Well, that question does vary. The answer on that question, I should say, on your personal financial situation and different variables. Now, in a later video that's going to be coming up shortly, we are going to try to help you come up with that kind of answer yourself. Somewhere along the lines, the video is going to be called Over Diversification, Is It a Real Thing? And we'll talk about that, how many stocks you should own, and whether it's an issue, whether you can be over diversified or not. Next, we're going to talk about bonds. That's another great way to diversify if you don't want to be 100% equity, meaning having all your portfolio in stocks. One good option is corporate bonds. With corporate bonds, what happens is you're investing in company debt. So individual companies sell bonds and you can buy those bonds. Now, there's different ratings they give the bonds. One classification is investment grade. That's like a higher credit score. So those are more safe bonds, they're safer companies, they have a higher credit score in a sense when it comes to debt. And then there's also high yield junk bonds. They do pay a higher yield. I don't think it's very high, but it is a higher yield compared to an investment grade. With those ones, they call them junk bonds, but they're not really junk. There is some that might be, you might be wary of, that you might not want to invest in, but for the most part, they're still somewhat safe, and they're not garbage companies. They just have a lower credit score. Something to take into consideration too when you're looking at corporate bonds is you'll probably want to use an ETF, because with at least corporate bonds, at least from Fidelity, that's my personal experience, is they charge $1,000 per bond and you have to buy a minimum of 5. So you have to put $5,000 a pop into each company you want to invest into. So that can get pretty expensive. So ETFs are going to be your best bet when it comes to investing in bonds, unless you have a really big cash portfolio, or a lot of money I should say in your portfolio, where you feel comfortable investing in multiple bonds, possibly spending $25,000 to $100,000 just in bonds, if not more, to have diversification within the bonds. Now the next one we're going to talk about is government municipal bonds. When it comes to those bonds, they're supposedly a little bit safer because they're backed by state and local governments. So they'll be like a city government, a county government, or state government issuing debt to you. And when it comes with that, some of the advantages are taxes. They are federally tax exempt, which is great, so you won't have to pay federal taxes, and depending on what state you buy them from and what state you live in, you might be exempt from state taxes as well. Now, if we move on from there, you also have U.S. treasuries. Those are considered the safest bonds. You're investing in the U.S. government debt. And when it comes to treasuries, they do yield the lowest, but it's a decent yield, and it's very, very safe. So somebody might say, well, why do I want to invest in that? Why are they so safe? The same reason you put money in a bank account that's FDI insured. You're trusting if something happened, the government's going to give your money back. The same thing happens with the U.S. treasuries. You're investing in the United States government. So if anything happens, you're going to get paid back, so you shouldn't have to worry. Now, if you're wondering which one to invest in, how much to put in each one, there's a lot of different questions you could be asking yourself right now. One option is BND. That's a total bond market fund, and they invest in over 18,000 different holdings they have. So that's a lot of different bonds across corporate, government, municipal bonds, the U.S. treasuries, investment grade, junk. You get everything in there. We have a lot more to talk about. Just some things I wanted to mention. One, the thumbnails are color coded. So if you look at the thumbnails for the videos, if they're blue, they're for educational. If they're green, they're more of a portfolio update, maybe how much dividends I made for the month or in premiums. Another thing is these videos do take a lot of time to make, believe it or not. The biggest thing you can do to help us out is click the subscribe button, like the videos, click the notification bell. And then if you guys want a free stock, you guys can sign up for Robinhood and get a free stock. There's an affiliate link down below for that. And also if there's anything you guys need to buy on Amazon, there's an affiliate link for that. It's for, if you click on it, it's for a book. You don't have to get the book. You can buy anything you want on Amazon. Getting back into diversification, we're now going to talk about a unique method you can use to diversify, and that is investing in mega and large caps. If you remember, we talked about market caps before. If you invest in a mega or large cap, a lot of times what happens is they do the diversification for you. A good example is Disney. If you think about Disney, yes, they have the resorts, yes, they have their parks, they have cruise ships, but they also own media, a lot of media. For example, they own the Hulu, ESPN, Disney Plus, but if you look on the screen, you can see that they own so many more companies as well. It's also like a utility company too, the media section, because people have to have some kind of content to watch. Just like they have to have phone service, just like they have to have internet. Also, they own so much real estate. They own a lot of land in Florida, a lot of acres.
Now, another great example of diversification is Pepsi. Pepsi owns a lot of different companies. Not only do they own the Pepsi Cola, they also own Frito-Lay snacks. Both of those are unhealthy, but they also own, if you look on the list, plenty of healthy alternatives too. They own so many different products, and even more products that aren't even on the screen. Another unique way you can use to diversify is allocating some money towards cash or cash equivalents, or even both. Now, you don't have to allocate any money towards cash, but it's definitely something you should consider. Reason being is, in a recession, like we have the 2020 recession going on right now, it does come in handy, especially if you see a great deal, or even when there's not a recession going on, if you see a bargain, you'll have some cash ready to be deployed. But you don't want it physically sitting in cash, you want it at least in a high interest savings account, not just in a regular checking or standard savings, like for example Ally Bank. Now, I'm not affiliated with Ally Bank at all, but it's just one source you could use. Now, if you have an HSA account and you have any excess money, maybe you have more in there than your deductible, don't just have it sitting there. At least put it in a CD, something. So that's very important. Even if you're not beating inflation, at least you're beating 0%, or what a lot of banks offer, 0.1%. Now, we talk about cash equivalents. Warren Buffett has $137 billion in cash, they say, but most of it's actually in cash equivalents, if not all of it. I'm assuming he has some in cash, but the majority of it has to be in cash equivalents. So what does he invest in? Short-term treasuries. That's what I suggest too, as a cash equivalents. And a good fund for that is a Vanguard fund, VXUS. Treasuries also act like a hedge. So that's something to take into consideration. So if the stock market crashes or stocks go down, usually US Treasuries go up. And what you could do is then take that money that's gone up and buy your favorite stocks that have gone down. Another alternative to short-term treasuries, if you want a little bit more yield, would be short-term corporate bonds. And a good fund for that is Vanguard. It's VXUS. And with that, it works as a hedge too. Bonds will go down too. Short-term bonds will go down less than regular intermediate or long-term corporate bonds. But what will happen is they won't go down as much as stocks do. So again, you won't lose as much money, and you can also then sell your short-term bonds and buy your favorite stocks at a discount. The best way, I think personally, to diversify is use a combination of everything we've talked about currently. That means have some stocks, some ETFs, some bonds, and maybe some cash equivalents or cash. Now, if you're not comfortable investing in individual stocks, then just stick with the ETFs. That's what I would do. Me personally, I invest mostly in individual stocks, but I do have some ETFs. If you're starting out and you have all ETFs, maybe you want to dip your toes in and get a few individual stocks. That's definitely an option you could do. And then start with those mega caps like I talked about earlier. But if you start getting stocks and you also have ETFs, some nice things are that, let's say you do go by kind of some sector allocations. That's what I do personally. I try to have stocks in all sectors, but you see that there's some sectors that you don't have any exposure, or maybe you don't know what stocks to buy individually and you want exposure to a certain sector. The nice thing is there is actual sector ETFs. One that's really nice, clean to the point, is Spider ETFs, SPDR. You don't have to go with that specific company. I don't know honestly that they are the best, but they are geared specifically towards sectors. That's definitely a great option if you're looking for individual sector ETFs. The nice thing about this method too is when you do both ETFs and stocks is that you can experiment with both in a sense. So, and the same with the bonds. You can watch all three of them and see how they're performing. You can keep some cash and cash equivalents on the side, and let's say you never really use them and you don't feel that they're needed, you can always change your portfolio later and change your allocation. That's something to remember. Don't make rules for yourself that's going to hold you back from making money. I hope this video helped you guys with seeing diversification from multiple angles, and I hope you guys have a wonderful day. Thanks again for sticking through the whole video and watching.